Good afternoon, everyone, and welcome to the October version of Making Sense of the Markets with Chris Curlo and Team LWC. In today's webinar, we'll cover the latest on central bank moves, small cap equities, and a special look at risk events. If you have any questions, please write them in the chat, and we will get back to them at the end of the webinar. Over to you, Chris.
Thanks, Adam. And if you could just mute your line while I'm presenting, and we'll pick it up as we're in the same building and office today. So we titled this month's webinar, Thankful for the Improving Data, in lieu of yesterday's Canadian Thanksgiving. Data on the inflation side continues to come in better than expected, meaning lower. You can see those Fed rate expectations have been moving down. That's USG, but not only is unemployment and PCE inflation kind of inside those bounds, this is driving down growth expectations. That's kind of what's driving down the longer term bond yields over the last several months, although we've seen a slight recent shift higher. So although the good news, it's almost bad news is good news, meaning it's allowing the Fed to cut more on the interest rate side, but it does mean slowing growth, particularly moreover here in Canada with our CPI dipping to 1.6% in September, down from 2% in August. That has not been fantastic for the loonie, drifting up to 138 per greenback. However, this was driven by lower gasoline prices, something that we've discussed in recent months. Core inflation has remained unchanged from the month prior. If you can remember from last month, we talked about that oil conundrum that we're facing on the inflation side as we had much higher WTI prices at this time last year. On the encouraging news, we are probably going to see another cut by the Bank of Canada, potentially a double cut, 50 basis points during their next meeting. It's about a 50-50 coin flip there. We would expect to see that 50% cut. Again, not going to be good for the loonie, but good for those variable rate mortgages that many of us may have out there in the market. On the US side, they're pegging another 84% that we'll see a 25 basis point cut when the Fed is up next. Adding to that has been manufacturing prices, which moved significantly lower from 54 to 48.3. Everything above 50 is an expansion territory. Below 50 is contraction. So you're seeing those manufacturing prices starting to come down in the United States. That has markets rocking to all-time highs, with the S&P 500 eking out all-time highs yet again last week. That's catching up to the price to earnings ratio, as you can see here in the chart on the bottom left. We are increasingly more bullish on opportunities outside of the United States. We pared back our US exposure in September in favor of more Canadian equities. Remember that the market is not the economy. We believe that this recession or pullback in GDP growth was priced in for the last year or so, and that's given this valuation disconnect. And we should be seeing out the other side here shortly. That's also led us to add more exposure to global small cap companies. You can see the performance of small caps following the Fed's first rate cut tends to allow them to outperform. Many of these Russell 2000 companies, about 40%, own floating rate debt. So lower interest rates means lower borrowing costs and easier access to capital for them to grow their businesses even quicker. We've added that exposure back in June. It's been up substantially, over 7% since that time period. Fortunately, as well, in Q3, our Canadian dividend model was up a whopping 15%. This was led higher by a lot of those interest rate sensitive companies, those that act almost like bond proxies. You can think about the real estate investment trusts, industrials, utilities, all of which we own in those portfolios for our clients, have done quite well in the recent months since we've seen this declining rate environment. With all that said, the Fed continues to pile debt on, having issued another debt limit increase in the United States. In 2013, the US was rolling over approximately $100 billion in bills on a weekly basis. They expected that to subside. 6 years later, it's 500 billion a week. That is substantial. A lot of this debt issuance is coming at the front end of the curve as well. So more and more debt gets rolled over. We have seen net treasury buying relatively stable in the past several years, but the mix of those buyers has changed substantially. A lot of big governments, notably China, India, Russia, are reducing their treasury reserves on their balance sheet in favor of other asset classes, mainly gold. Gold holdings have been increasing in a lot of central bank reserves as the US dollar is starting to lose a bit of that security. You can imagine if those buyers slow down, they're going to have to issue that at much higher interest rates, which would further increase the debt burden, as well as rolling off on the long end. A lot of that debt that was issued several years ago was at substantially lower rates. So refinancing that with new higher rate paper is quite an expensive task. Who's picking up the buying? It's been countries such as the Cayman Island, Switzerland, the United Kingdom, where a lot of hedge funds tend to reside and are purchasing these treasuries as collateral for leveraging long, in a lot of cases, equity positions. Those buyers tend to be less sticky than governments. This is something we're keeping our eyes on and have added a reasonable amount of gold exposure to our portfolios. Gold tends to do well in a falling rate environment. Gold is essentially like a zero coupon bond, long duration, finite asset. When rates go down, the price goes up. And we've been seeing that here near all-time highs at $2,700 an ounce. We think that the gold miners still even have some catch up to the rise in the commodity that we've seen over the past year and a half or so. Without trying to get political, as politics are a hard thing to judge, particularly their impact on the markets. Just looking back historically, when you see a split Senate and House, that has tended to been favorable for equity markets versus a non-split Senate and House tends to be a little bit worse. We're showing that here in the chart on the bottom right, with Democratic presidents and a Democratic Senate, Republican House, a Republican president, Democratic House, Republican Senate tend to be the two highest. And you can see that the non-splits just tend not to do quite as well.
Thanks, Chris. Now looking at what rare events can teach us and the common mistakes that we can fall prey to as investors and how to avoid them. So the first one is near and dear to my heart as a basketball fan. I'm a big Toronto fan, so every year I think we're going to win the championship. And I think about the young players that we have and get all excited about that possibility. And what Kahneman showed is that he asked everyone to predict the probability of each team in this league winning the championship. The probabilities should equal 100% because only one team can win. However, they added up to 240%. So people way overestimated the likelihood of a particular team winning. And this teaches us the first bias, which if we don't consider all of the alternatives, we tend to overestimate the likelihood of success. This is very relevant in investing. A good example is the dot-com bubble. Everyone knew that the internet was going to be the next big thing, but they didn't consider the alternatives. So only a few players can really take that leadership role, and not everyone. So moving on to the second bias, we have what Kahneman calls vividness. Simply put, that means how easy is it to picture something in your head? And we'll see with this example, the easier it is to visualize, the more probability that people assign to it. So in a landmark study, participants were asked to pick which situation would it be easier to pick a red marble out of a bag of marbles. And as we can see, earn A is clearly the higher chance of picking the red marble. However, shockingly, 30 to 40% of people picked EarnB. And this is simply because there were more red marbles in EarnB, so it's easier to picture. So what does this teach us? First, whenever possible, when we're making a decision, we have to quantify how likely is it going to occur. Don't just trust your first instinct. Secondly, always figure out what are the alternatives. Don't just get excited about one possible view. Think about all of the possible different scenarios that may happen. So that, as true in sports, this is also very true in different sectors in investing. And lastly, we're all incredibly susceptible to these biases when we're just working with ourselves. We're not aware of some of the shortfalls that we have. That's why it's really important to work with a trusted advisor to ensure that you understand the big picture and you're not missing any key details.